Despite some of the worst economic data in history, the bulls have been in control. The bears have been beaten up. They're starting to fight back. Who's going to win this fight? Lots to talk about. Sit back and let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street MBTV, believe me, you won't see this on CNBC. Please do consider subscribing, hitting that like button, and all that fun stuff. Today's agenda, we're going to start with the big charts. We are seeing changes, breakdowns, movement, very important to stay close on this. Sector spotlight. The cycles are changing. We've got some moves there. What keeps me up at night? And game plan going forward to help you. So first up, let's go to the big charts. All right, first up, we're going to go into monthly chart, the long-term view. What do we see here? A couple things. First off, up here is what's called relative strength. And you see we hit some high numbers when we were at previous highs, but now that line is going down. That's called negative divergence. So relative strength is going down while this market has gone up. That is not a good sign. The other thing down here, waiting for it, did not happen. Thought we were going to get a crossover, which would have moved this chart to positive. But right now, the long-term view is still negative. Next up, we have our weekly chart. Any changes here? No. On our weekly view, midterm view, we are positive. But last week, you see here, that's the 40-week moving average, okay? We broke it. We did hold it. Not this morning. This is Monday morning. Looking at futures, you still have a positive crossover. So again, that's good for the midterm right now. So right now, continued, we're going to call our midterm view is positive, okay? So the next one is our short term where we're having some problems, okay? So obviously we had what's called a gap down. You see that, right? Straight down from this level to that level right there. Now, the other thing is it held the 200-day moving average, came above it on Friday. Futures today are down pretty big, okay? So we expect at this point to go below it. The other thing is you see up here, here's your relative strength. It held 50, which is a good sign. I don't think that's going to be the case today, okay? What else do we see here on this chart? I think down here at the bottom are two key components. Excuse me. First off, okay, the VIX, again, above 30 is uninvestable. Now, when we were in that 25, and that's what we held 25, you're trading, there's still some opportunity, but you have to be careful. Above 30, uninvestable, okay? And then right there. So we've had a negative crossover on the short term. So that tells us right now that as of today, we'll get confirmation based on this morning's future. The short-term view is negative as well. So what else do we see that's behind the scenes that's helping me make my decisions right now? So here's S&P mid and small, and you can see here, hopefully, 17% negative year to date with mid caps. That's going to go lower. Small caps are still in a bear market, okay, minus 21%. So if everybody's not joining the party, it's not a party. So that's concerning. The other thing is the NYSE. Remember, the S&P is only 500 companies really being driven by the FANGs right now, those 5 names. So when you look at today on the NYSE, it's down 19.7 year to date. So With today's move, probably we'll go back into bear territory, and we've had a negative. So the other thing that I look for, this is a new chart, a lot going on here, just bear with me, okay? So what I have is, in the red behind is your S&P, okay? Down here is the put-call ratio. Now last week you can see we hit an all-time low at 37. So what that means is everybody's long the market. Lots of complacency. And each time you have a turn, right, you can see, right, you've got tops in the market, bottoms in the market, and that's how you do it. Then what I've done is I've added an inverse put-call ratio, and you can see how they move together in a lot of cases, okay? This is already down. That's going to lead the market lower. This tells us that sentiment is changing. The money's changing, right? They're pulling that away, okay? So that's another chart that I look at, and here's something I've shown for a while. NYSE Daily, new highs minus new lows. This is critical because it's going to show you what's happening underneath the market, right? And you can see here, look, nothing, just nothing. We're not getting anything. The market has meandered along as we have gotten to new highs. Now here you see that new highs have outperformed when the market was up. So that has always been a concern for me year to date. Now last up is treasuries. This is important. Why? Because everybody thought the treasury market was going the other direction last week when we popped to all of 0.92. Now I will tell you right now, our trend change is about 1.4 on the 10-year. That's going to change the trend. We went up there. There's speculation that some traders got some early numbers on the unemployment report. It popped up and then down last week, 0.71. So as of right now, treasuries continue to be one of our bigger holdings. Like this kind of information, don't forget to like and subscribe. Next up, Sector Spotlight. Okay, first up in our Sector Spotlight, healthcare, of course, with what's going on right now. Now, we did see last week, a big hit last week. Healthcare has gone a long way. I was already in a full position, but it was a buying opportunity, probably still a buying opportunity. On the short term, we went way oversold. So I think the healthcare continues to be a good sector as we go forward for obvious reasons. So we've got healthcare, and then we also have biotech in our holdings. Now we have seen a change in cycles. We'll talk about that in a second, but in that, certain asset classes do well. One of those is utilities. Kind of went down. We started buying back in. Now again, got hit late last week with everything else. We'll see where this correction takes us, because as you see, when we did have the big correction back in March, everything got hurt. But that being said, okay, this might be a good opportunity. I might add to our holdings there today at the end of the day. And then consumer staples, right? They continue to sell. When you look here with consumer staples, has had a nice move up. Even though we went down the other day, now it was up on the down day, it did hold its 50-day moving average. So right now, continue to like it. It's still in a bullish up pattern, okay? Relative strengths come down a little bit, so might be an opportunity at a full position for us right now, but do like consumer staples going forward. The next thing, my last one on Sector Spotlight, is commodities. Why? Well, we're starting to see inflation tick up. We'll talk about that in a second, but you see the CRB index, okay, how's it went down, and now it's gone up, which tells us inflation is coming about. We'll talk about that in a second, but we started tiptoeing in a couple things, really starting to watch some of those commodity areas. Next up, what keeps me up at night? All right, first up, we're going to talk about cycles. But again, this is the kind of stuff you're not seeing on TV, okay? When you look at the various cycles, we're in cycle 4, growth slowing, inflation decelerates, Fed dovish, markets deflate. Well, guess what, folks? We've had a move, big time. How do you see that? I see that in the dollar really leading that down, showing us we're going to talk about that some more. So growth slowing, remember that. Inflation accelerates. Are you feeling that at the grocery store? Fed is neutral and markets are stagflating. So stagflation, think about that as we go forward. So first up, slowing. Hello, GDP minus 46% is projected this quarter. And as Kramer says, yes, this is hideous. Next up, here's the world GDP. Now, you might see a trend here, okay? Everybody minus 14%. The best, Korea is looking at a minus 2%. So this is not just a US thing. This is a global slowdown that is going on right now, okay? Next up, we have PPI. All right, that shows you inflation. I think I skipped over one I did. CPI, 3 months in a row going higher. There's your inflation confirmed with PPI. And here is the commodities index that we showed a second ago. And you see that going up. That's what we're looking for in this cycle to take advantage of some of our holdings, some of our sectors. Okay, next up, continuous claims. As I said, this is what I'm looking for, okay? But last week, okay, and unemployment came out and everyone went gaga because it was 13%, but the fact is the real number was 16%, okay? They did not count about 4 million jobs, and that's a problem. So I can continue to watch the continuous claims, which is still north of 20 million people, okay? We have never seen that, okay? So continuous claims with unemployments, and then now JOLTS, job openings. Look at that go crashing. So not only seeing unemployment, but job openings going down as well. So if people aren't working, look at personal savings shoot through the roof. Unbelievable how much this has gone up, okay? And what does that affect? The shopping carts are empty. Retail sales a month ago minus 5%, about minus 22%. This all comes together on the fundamental side to show us there is a lot of weakness out there, folks. Been talking about it. Probably one of the few, which is why we've been underweight equity. So with the Fed, they've stepped in, right? If you're new here, liquidity, right? They're pumping in all this liquidity. We have Chairman Powell pumping that out, right? We've gone over $7 trillion in Fed money. That is absolutely awful. This is nothing but a problem. So the Fed has helped short term with liquidity, but as I said in our last video, they're not going to be able to help solvency. So what's happening? Bankruptcies. Bankruptcies in a big way, okay? Small business owners starting to go out. I mean, I saw something the other day in Denver. They're looking at over 50% retail and restaurants. That's the next stage of this, solvency. And unfortunately, we're starting to see that in a big way. So when will this end? Not sure, okay? What we want to look at, though, is what kind of recovery. Now, the market, CNBC, right, kept saying a V-shaped recovery, 2 or 3 months. Well, with everything I just showed you, okay, what we're starting to see going forward, which is getting worse, okay, I do not anticipate a V-shaped recovery at all. The question is, U-shaped global slowdown. Well, we saw that in the world GDP, right? Multiple waves. Not sure yet, but I do not see a V-shaped recovery. We'll come back to that, right? What's your number? So today, if we hold, right, we're going to be down close to 10% again. So you have to be comfortable with a number before you make opportunities. Find opportunities on upside and downside. I keep saying that. The cycles have changed. That's what I'm looking for now. But these might be short-term trades, have not hedged or shorted the market yet, but looking at that. Back above 30 on the volatility index. That's a problem. Last, most important, follow us on Facebook and Twitter. I'm allowed to speak there, meaning I can respond there, not here on YouTube, but we're always putting out good information to help our clients and YouTube subscribers. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.